Hey everyone, welcome back. It feels like everywhere you turn these days, it's AI this and AI that. Valuations are going crazy. It really does feel like we're in a repeat of the dot-com boom, but this time it's AI at the center of it all. So it's making a lot of us wonder, are we about to blast off into some incredible new era, or are we heading straight for another bubble that's about to burst?
Well, it is the question, isn't it? And actually, legendary investor Howard Marks at Oaktree Capital just put out a new memo. It's called On Bubble Watch. And he kind of breaks down exactly what makes a bubble a bubble. And he takes a hard look at whether we're seeing those same warning signs flashing today.
Okay, so before we get into whether or not AI is actually a bubble, let's back up a second for anyone who hasn't had a chance to dive into On Bubble Watch yet. Can you give us the Howard Marks crash course on what defines a bubble?
Sure. So it's not just about prices going up. I mean, that's part of it. But Marx really digs into this idea that a true bubble is marked by this kind of contagious euphoria, this irrational exuberance, he calls it, where logic basically gets thrown out the window and people just pile into investments just because everybody else is doing it. They don't want to miss out. It's like that old story about JP Morgan. When his shoeshine boys started giving him stock tips, he knew the market was way too hot and it was time to sell.
Right, because if the shoeshine boy is suddenly a market expert, things are probably a little out of whack. But can we really compare that story to what's going on with AI today? Are we really seeing that same kind of blind optimism?
Well, I think there are some pretty interesting parallels. Marx outlines these three stages of a bull market. So in that first stage, you have a few people who are really forward-thinking. They recognize a legitimate opportunity. And then in stage two, more investors start to catch on as that opportunity proves itself out and the fundamentals improve. But it's in that third stage where things can get a little, I don't know, dangerous. It's like a party that gets a little too wild. Everybody's piling in, the music's blasting, and nobody wants to go home, even though they probably should. And that's when you start to see those classic bubble signs. Valuations start to detach from reality. People throw money at anything that's even remotely connected to the hot sector. And everyone's convinced it's just going to last forever.
So you're saying even if there is real potential behind a new technology or a trend, that initial enthusiasm can kind of spiral into something unsustainable, something bubbly.
Exactly. And what's interesting about AI is that it really does check a lot of the boxes for a potential bubble. It's
Yeah.
new, it's exciting, and it has the potential to completely transform industries. But that new thing factor makes it really hard to value and really easy to hype. And then you have that this time it's different narrative. That always seems to pop up during bubbles. People convince themselves that the old rules don't apply. This time the growth is totally justified. The sky is the limit.
Okay, so I'm starting to see the warning signs here. But let's get specific. What are some of the red flags that have Howard Marks kind of ringing the alarm bells about a potential AI bubble?
So one of his biggest concerns is the concentration of market gains in just a handful of these mega cap tech companies, what some are calling the Magnificent Seven. We're talking about Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla. Their combined market cap now represents something like 33% of the entire S&P 500, which is double their share just 5 years ago.
Wow, that's huge. And didn't you say that this concentration is actually even higher than what we saw at the peak of the dot-com bubble?
It is. And while some of these companies are definitely strong and innovative, Marx really cautions against assuming that their dominance will last forever. He points to the Nifty 50, those blue chip stocks from the 1970s, companies like IBM, Xerox, and Kodak, the giants of their day. Investors were convinced they were surefire bets. But guess what? Only about half of those companies are even still in the S&P 500 today.
It's true, the landscape of business can change so fast, and betting on that kind of perpetual dominance is a risky game. Okay, so concentration of market gains in a few companies is one red flag. What else is Marx worried about?
Well, he's also concerned about the overall market valuation. So the S&P 500 price to earnings ratio, which is basically a measure of how much investors are willing to pay for every dollar of earnings, is currently sitting around 22. Now the historical average is closer to 15.
So we're paying a pretty big premium for stocks right now, but haven't we seen some pretty amazing returns in the market the past couple of years? Maybe that justifies those higher valuations.
Well, that's what a lot of people are saying. But Marx highlights this really interesting chart from JP Morgan. That basically tracks the relationship between starting valuations and then the 10-year returns that follow. So imagine a graph where the higher you go on one axis, that's the starting valuation. The lower you go on the other, that's your future return. That's basically what this chart shows. It's a little bit of a reality check.
So according to this chart with our current S&P 500 PE ratio of 22, what kind of returns are we looking at over the next 10 years?
Well, based on the historical data, a PE ratio of 22 usually leads to 10-year returns somewhere between -2% and +2%, which is a far cry from those double-digit returns that a lot of investors have gotten used to.
Yeah, that's definitely something to think about. So we've got market concentration, overall valuations. Those are potential warning signs. What else is Howard Marks worried about the current market?
He's also concerned about this recent surge in market returns. We've seen the S&P 500 deliver some pretty remarkable gains in 2023 and 2024, the best two-year stretch since the late 90s. And while that's obviously exciting, Marx reminds us that historically, those periods of really exceptional returns are often followed by periods of decline. It's like a pendulum swinging back and forth. Things rarely stay at one extreme for very long.
So it's not just about where we are now, it's about understanding where we might be headed based on those historical patterns. And those patterns, at least according to Howard Marks, seem to be pointing towards a potential correction. But is it really fair to compare what's happening with AI to past bubbles like the dot-com boom? Aren't there some pretty key differences this time around?
That's the million-dollar question, isn't it? And that's where we'll dive deeper in the next part of this deep dive. We'll explore whether this AI rally is really a bubble, whether it could lead to another lost decade for investors, and what strategies might actually help us navigate this really uncertain terrain.
Welcome back, everyone. So before the break, we were really dissecting Howard Marks's On Bubble Watch memo and kind of painting this picture of the potential risks that are lurking out there in the market, especially with all the hype around AI. But I want to play devil's advocate for a minute. Is it possible we're being a little too cautious here? I mean, these Magnificent Seven companies, they're not exactly fly-by-night operations, right? They're making huge profits. They're driving real innovation. So isn't that different from those flimsy dot-com companies that just imploded back in the early 2000s?
Yeah, you raise a really good point. There are definitely some key differences between what we're seeing now and what happened back in the dot-com era. A lot of these leading tech companies today, they're profitable, they've proven business models, they're sitting on mountains of cash, they're not just peddling dreams of future riches.
True, but it still feels like there's a lot of exuberance baked into the market right now. So let's talk about the elephant in the room. Could this AI frenzy actually lead us down the same path as the dot-com bubble and trigger another lost decade for investors?
I mean, that's the fear, right? And Marx definitely doesn't shy away from addressing it. He points out that while some optimism is definitely justified, investors need to be careful about extrapolating that recent performance into the future. Just because a company has done incredibly well the past couple of years doesn't mean that that trend is just going to continue forever. Competition, disruption, changing market dynamics, all those things can derail even the most seemingly invincible companies.
So you're saying the persistence,
Yeah,
the idea that these companies are just going to stay on top, it's not a guarantee.
exactly. It's a bet. And like any bet, there's a chance you could lose. And, the history of the stock market is just littered with examples of companies that were once considered untouchable. But they ultimately fell from grace. I mean, look at the Nifty 50. They were supposed to be like the ultimate buy and hold investments. But so many of them either flamed out or they just failed to keep up with the broader market.
Okay, so let's shift gears a little bit and talk about how all of this might impact different investing styles. So passive investing. Things like index funds that track the overall market. That's been incredibly popular the last few years. But if we were heading for a bubble burst, would that strategy still work?
That's a really good question, and it's something a lot of investors are grappling with right now. During a bubble, everything tends to go up together. So those passive strategies can definitely benefit from that indiscriminate upswing. But when that bubble bursts, that correction can be really swift and really brutal. And because index funds track the whole market, they don't have the ability to sidestep those falling knives.
So does it mean that active management, where you have portfolio managers picking and choosing individual stocks, is that the way to go in a bubble-prone environment?
Well, it's not quite that simple. Active management has its own challenges. Not all active managers are created equal. Some might be able to navigate a bubble successfully, but others might get caught up in the frenzy and make some really bad decisions.
Okay, so it sounds like there's no easy answer. When it comes to passive versus active in a potential bubble,
Right.
it really comes down to your own personal risk tolerance, your investment goals, and honestly, how much faith you have in your ability to either pick winning stocks yourself or find a skilled active manager who can do it for you. But let's talk about another style of investing that seems to be struggling in this AI-fueled market. Value investing. This is Howard Marks's bread and butter. But even he admits that value has really underperformed during this recent rally. So what's the outlook for value investing if we are in a bubble? And what should those of us who are feeling maybe a little beaten down right now be doing?
Yeah, that's a tough pill to swallow for value investors who are feeling left behind in this market. It can be really frustrating to watch these high-flying growth stocks just soar while your carefully chosen value picks kind of lag behind. But Marx argues that, value investing, it's inherently contrarian. It's about going against that herd mentality, ignoring the hype, and focusing on the fundamentals. And that can be painful in the short term, especially during a bubble when growth at any price is the mantra.
So it sounds like value investors need to have a strong stomach and a really long-term perspective.
Yeah.
They have to be willing to kind of weather the storm and trust that eventually the market will recognize the true value of their holdings.
Exactly. Patience and discipline are essential for value investors, especially when their style's out of favor. Remember, value investing, it's not about timing the market perfectly. It's about buying assets for less than they're worth and waiting for that value to be recognized. And sometimes that recognition can take longer than we'd like.
But that's a tough message to hear when you've seen your portfolio underperform and everybody else is celebrating these record gains. So what's Mark's advice to value investors who are feeling discouraged right now?
He emphasizes how important it is to just stick to your principles. Don't get swayed by the market's short-term whims. Don't abandon your strategy just because it's not currently in vogue. Remember, market cycles come and go. Growth will eventually slow down. Valuations will adjust. And value investing will likely have its day in the sun again.
So for value investors, it's about staying the course, tuning out the noise, focusing on what you can control. Your investment process, your risk tolerance, your time horizon. It's about remembering that just like a rocket, what goes up must eventually come down.
Exactly. And when that happens, being well-positioned with a portfolio of undervalued assets can be a huge advantage.
This has been such an insightful conversation, but I feel like we've only just scratched the surface of this really complex topic. So as we kind of wrap up this part of our deep dive, what are some key takeaways for our listeners as they try to make sense of this AI-driven market and decide how to position their own portfolios?
Well, I think the first takeaway is that while AI holds incredible promise, it's really important to approach it with a healthy dose of skepticism. Don't let the hype cloud your judgment. Do your own research, understand the risks, be realistic about potential returns.
So don't just blindly jump on the AI bandwagon because everyone else is.
Right. And I think the second takeaway is that valuations matter. Whether we're talking about the Nifty 50 of the past or the Magnificent Seven today, a great company can be a terrible investment if you overpay for it. Remember Mark's core message. It's not what you buy, it's what you pay that counts.
That is such a simple yet powerful concept.
Right.
It's a reminder that investing isn't just about picking the right companies. It's about understanding the price you're paying for those companies and making sure you're getting a good deal.
Exactly. And finally, I think it's important to remember that market cycles are inevitable, periods of exuberance and rapid growth. Those are often followed by periods of correction and consolidation. So don't let those swings deter you from your long-term investment goals. Stay disciplined, stay informed, and stay focused on those fundamentals.
It's all about taking that long-term perspective and not getting caught up in the short-term noise. But that's easier said than done when you're constantly being bombarded by these headlines about AI breakthroughs and skyrocketing stock prices.
It is challenging, but that's where having a really sound investment philosophy and a trusted advisor can be really invaluable.
So as we wrap up this part of our deep dive, what's the one question our listeners should be asking themselves as they navigate this exciting and potentially perilous market? I think the question we all need to be asking is, knowing what we know about bubbles and about market history and about Howard Marks's perspective, what would make us more or less concerned about an AI bubble?
That's a good question. I think there are a few things to watch for. First, pay close attention to those valuations. If we keep seeing these price to earnings ratios expand, especially for companies that haven't really proven that they can consistently turn a profit, that would be a big red flag. It would tell us that investors are getting caught up in all the hype and just throwing money at anything AI related, just because it's the hot new thing.
Right, so it's not just about whether a company is doing something with AI, it's about whether the price you're paying makes sense based on what they're actually earning and what their growth potential really is.
Exactly. And then second, keep an eye on interest rates and the overall economic environment. Low interest rates have really fueled a lot of the market exuberance we've seen. So if rates start to climb significantly, that could really put a damper on growth and make investors rethink some of those sky-high valuations.
Right, because higher interest rates make it more expensive for companies to borrow money, which can impact their plans and their profitability. And it also makes other investments like bonds look more appealing,
Hmm.
which could pull money out of the stock market.
Exactly. And then the third thing to watch for is any signs of excessive speculation or leverage. Are investors borrowing a lot of money to buy AI-related stocks? Are we seeing a surge in those risky derivative trades or options trading? Those kinds of behaviors can signal that things are getting a little out of control.
Yeah, it's like that feeling of euphoria we were talking about earlier.
Hmm.
But take it to the extreme, where people just start taking bigger and bigger risks because they're convinced the party's never going to end.
Right. And those are often the times when things can unravel really quickly.
So as we wrap up our deep dive into this potential AI bubble, it's clear that there's no easy answer. There are valid arguments on both sides. But by understanding that historical context and recognizing the warning signs and asking ourselves those tough questions, hopefully we can make more informed decisions and avoid repeating those same mistakes of the past.
Absolutely. It's all about being informed, being thoughtful, and being prepared for whatever the market throws at us.
And remember, this isn't just about AI. This is about understanding how markets work, how bubbles form, and how to protect ourselves from getting swept up in all the hype. Because whether it's AI, blockchain, or whatever the next big thing is, the underlying dynamics are often the same.
Very true. History may not repeat itself, but it often rhymes.
Well said. So as we leave you to ponder all of this, we would love to hear your thoughts. What factors are making you more or less concerned about an AI bubble? Share your insights with us on social media or on the show's website.
And until next time, happy investing.
And remember, folks, stay curious, stay informed, and keep diving deep.